Business owners, this is for you. If you're running a company, you've already built something real. But if your profit margins are thin, your future is fragile. Hello, I'm Dr. Serena. I have a PhD in architecture with machine learning, and I help businesses become sellable. I help business owners like you turn what they've built into a business that's not just running, but is a valuable asset as well. When I say valuable, I'm referring to value. The type of value I'm referring the type of value I'm referring to is the value that is created when a company generates return on capital investment that exceeds the cost of the capital itself. Obviously, that's not just value, that is also risk. But let's get real for a second. If you're trading time and sweat for revenue and the profit margins remain super thin, you're sitting on a business that might continue to live, but it won't sell. So today I would like to talk about value creation. We've learned from people like Charlie Morgan that value is created when pain is eliminated, but this is referring to the value that something brings to a paying customer. The type of value that we're talking about today is a different type of value. It's more special. So if you were to think about a business, it kind of exists on two planes. It exists on the physical plane where the core business takes place, the marketing takes place, the sales process takes place, the customer fulfillment takes place, like exchanging services for money and stuff like that. Time happens linearly. But then there's another plane on which businesses exist. Well, most of businesses, no. I was going to say that most businesses don't exist on this plane, but they also exist because the whole idea of entrepreneurship is to create excess capital. And that excess capital, we just name profit. And profit gets taxed, but at the same time, profit is due to the shareholders. So on the physical plane, we have the business operations, how it generates value for the physical world. And on this higher level of value is where the shareholders lie, where the shareholders who've invested either time and or money, if they founded, or if they invested in the business, or if they gave a loan, they're somewhere here. And somehow the activities in the physical plane have to generate value for the physical plane as well, but also excess for the shareholders. As a side note, I understand that this is a controversial topic, like the bonuses that CEOs keep getting. They widen the payment gap, the revenue gap of everybody even more, but they're paid from a different pocket. You know what I mean? Because here on this higher plane of existence, we not only have the money generated by the business itself, but we also have capital from investors, from people who buy stock. And people don't buy stock necessarily because of the business operations here on this plane, but they buy stock for what happens here on the higher plane, which is about narrative, which is about company directions, which is about company politics and leadership and things like that. That being said, probably the best course of action for me to explain what that type of value is to go through a book I truly love from McKinsey called Value. And this is the very first, no, it's not. It's one of the first business books that I took seriously. I read this back in 2019, and I had a complete paradigm shift on what value truly is. Because, of course, like most of everybody, I thought value was the value of something, like the price tag of something. But no, this book perfectly describes what value creation is and how it's not directly related to the physical plane of the business, but more about this higher plane. And there are 4 cornerstones of value creation, which we're going to talk about today because I have the book right here. But before we get into it, I want to tell you why we're talking about this. So, I've mentioned that most business owners don't understand these two planes of existence. They only pay attention to one plane of existence, and they don't understand that the higher plane of existence, they're directly correlated, and they, of course, the correlation between the two highly affects the profit margin, even for the operations as well. And what I do could be generally classified as business management consultancy, but ultimately, I help business owners grow their profit margins without creating new operations by just leveraging their existing assets and focusing on the value creation itself. And the ultimate goal of this exercise is to make the business sellable, because I fundamentally believe that it is our freedom as individuals to come up with an idea and build and grow a business around this idea. And ultimately, if we get bored of this or like sick of it or just don't want to do it anymore, we have the right to sell it as any type of other asset. That being said, in my past experience, I have noticed that after we undergo this housekeeping of a business and it becomes more profitable, owners don't want to sell it anymore because they fall in love with the business again. That's okay. It's their right to decide if they want to keep the business or not. But when you buy a car, you don't trash it immediately because it's your property, right? You try and take care of it. Like you clean it, you buff out the scratches, you take care of the engine so it doesn't completely malfunction, and ultimately you're trying to keep that asset, if you could call it, of yours pretty valuable so you can sell it if and when you decide. We can do that with businesses as well, and it's actually way better than with cars. Cars are one of the stupidest things you can buy. Buy diamonds. Don't buy cars. My God. Anyway, boys will be boys. But let's get back to the value creation. Right. So there's no disputing that value is the defining metric in a market economy. When people invest, they expect the value of their investment to increase by an amount that sufficiently compensates their risk taking as well as the time value for their money. This is true for all types of investments, including bonds, bank accounts, real estate, or company shares. So, knowing how to create and measure value is an essential tool for any executive. The McKinsey book says that if we've learned anything from all the bubbles and all the crises and economic crashes, is that value creation, the laws of value creation and value measurement are timeless. This is what causes businesses to grow up to the age of over 100 because they've mastered these laws. And today we're going to talk about the 4 cornerstones of value creation. Let's just get into it. The first and guiding cornerstone is that companies create value by investing capital from investors to generate future cash flows at rates of return exceeding the cost of that capital. So the faster companies grow and deploy more capital at attractive rates of return, the more value they create. In short, the combination of growth and return on investment capital, or ROIC, drives value and value creation. The book goes, this is named in short the core of value and is a combination of growth and ROIC, and explains why some companies typically trade high price to earnings multiples despite low growth. Because the value, like I said, is not judged only by the operations that are having in the physical plane, but also in the higher plane as well. And these aspects of the higher plane are related to fiscal policy, politics, government incentives, number of users, number of data points, because ultimately what a valuation is a combination of both numbers and narratives. And I am absolutely fascinated about these things because it's like with science. I've heard a professor of philosophy talk about Aristotle and how cool he is because, and he really got me back into Aristotle, by the way, the Organon, I highly recommend, because that was a true golden age for the knowledge of humans, because science was understood as having certain limitations. The observable physical world made up only 50% of knowledge, as Aristotle identified, and the rest of the 50% was more bound to the soul and the heart, human understanding, human perception, which is highly subjective and you can't measure it. And this professor of philosophy said that if you can only define science by using science terms, that doesn't make it a domain. That makes it more like an ism, like scientism. And this is the case with the valuation of companies as well. Like, the numbers give only 50% of the picture, and the narrative gives another 50% of the picture. And there's a lovely book called Numbers and Narratives by the OG valuator. I forgot his name because it's a complicated name, but you guys know what I'm talking about. Shout out you guys who know that who I'm talking about. Anyway, it is your responsibility as a business owner, or it is your responsibility as a C-suite executive to pay attention to both these things. You have to pay attention to both the core business and all the operations of value creation. You have to pay attention on how the business presents itself, not only to the customers, but to other businesses as well. This is your job as a leader. And it took me 8 years to understand this thing because I was working in the business like everybody else. And I wasn't doing value creation. Even though I was reading all these books, I could not connect them directly to my business. So I guess my intermediate advice here is don't solely rely on self-education and individual reading and learning all by yourself, because you need a business mentor. I have a business mentor. He's the best in the world. Shout out Will Brown. But you need a business mentor so he can guide you through all of the literature and the knowledge and everything. It's not enough to only read about these things. You have to see how these apply in real life situations, and more the realist life situation is on yourself and on your business. But you're not going to do that until you see another human going through that thing, or you talk to another human who actually went through that thing. And if you like me as a human, there are useful links down below on how you can work with me. But if you don't want to do that, it's fine. Let's continue to the second pillar of value creation. Well, the second cornerstone of value creation. This is a corollary with the first. It says, value is created for shareholders when companies generate higher cash flows, not by rearranging investors' claims on those cash flows. We call this the conservation of value, or anything that doesn't increase cash flows via improving revenues or returns on capital doesn't really create value. And here, I would like to address the $100 billion pledges that companies like OpenAI and NVIDIA and Microsoft and whoever else is in that human centipede are doing currently. Because the money isn't real. The figures appear in the press and in all the communication, but the money isn't really real because it's pledges. There's not actual billions being handed over to each other. It's just value, you know? And that can be a very dangerous thing, as the second cornerstone says, because that's not generating new value. That's just like a bunch of stuffed toys drinking imaginary tea at a little girl's tea party. There's no tea in the cups, even if it is a tea party. Anyway, that's a little harsh, but I think that they've learned this little trick from the FTX thing. For those of you who don't know about the FTX thing that happened, I think 2 years ago, there was this crypto bro, Sam Bankman-Fried, I think his name was, and he had a token, and he did some gymnastics with the token, and basically fictionally doubled the value of all the market cap from that token into something called Alameda Research. He was doubling some money, but like that wasn't true. Needless to say, I think he went to jail for a little bit, but somehow he might be free now because of all his political connections, because he knew exactly where to spend that money that he was stealing from everybody. Yes. The book is now referencing something from The Wolf of Wall Street. We sometimes hear that when a high value company buys a low value company, the earnings of the low value company get re-rated at the value of the higher company. In growth, or ROIC, and cash flows of the combined company don't change. Why would the market revalue the target company's earnings? In addition to bad logic, the re-rating idea has no empirical support. That said, if the new combined earnings and cash flows improve as a result of the acquisition, then real value has been created. At the time I am filming this, it's 2025, and countries have credit ratings as well, and this gives them interest rates on loans from the IMF. And you would think that it's lovely and decentralized, but in reality, countries like Germany and France can just borrow money at any interest rate they want to. And France, I don't even know what the credit score for France is, but it's highly overevaluated, in my opinion. Like I said, it's 2025. We will see. Anyway, the third cornerstone of value creation is that a company's performance in the stock market is driven by changes in the stock market expectation, not just the company's actual performance. There you have it, my friend. The second plane of existence is not directly correlated to the physical plane of existence of the business itself. Companies can use the stock market and can use the higher plane to finance some of its operations. But this is a slippery slope if there's no proper proof of concept and historical value of the operations themselves. And the thing is that today we see a lot of startup companies that are raising capital for their business that most of the times have the word AI in the description or whatever. But what is happening is that the executives and the shareholders of that company, well, they're selling what is highest of value. And many times we see startups that are, when you actually look at the numbers and the books, they resemble a Ponzi scheme more than a startup itself, because they have initial investors in pre-seed or they have private debt. And at one point that debt reaches maturation and they have to pay the original investors back. And how they do that many times is they refinance them from new investors in the second cycle. And that doesn't look like a business, that looks like a Ponzi scheme. But this is one of the major pitfalls of private equity and private debt. More things happen on the higher plane of existence, and sometimes nothing happens in the physical plane of existence. The book gives the example of the large American retailer Home Depot. It lost half of the value of its shares from 1999 through 2009, despite growing revenues by 11% per year at an attractive ROIC. The decline in value can mostly be explained by Home Depot's unsustainably high value in 1999 at $132 billion, the justification of which would have required growth revenue of 26% per year for 15 years, a very unlikely, if not impossible feat. This is from 1999 through 2009. I know that if we look now at 26% per year for 15 years, we're gonna, being how the S&P 500 is behaving today, we're gonna think like, that's achievable. But no. I've actually read a book 2 days ago, which was about the cycles, the market cycles, and they said that in reality, the S&P experiences many, many highs, many, many lows. But if you look at it long term, you could actually expect growth of 10% and no more. Careful with that. The book also gives a reverse example. So Continental's AG, this is a German-based global auto supplier for tires. The shareholder benefited from low expectations at the beginning of 2003, which is such a German thing, by the way, when Continental's private evaluation was about 6. So 6. Over the next 3 years, the shareholders earned returns of 74% per year, about one-third of which can be attributed to the elimination of the negative expectations and the return of Continental's valuation to a more normal level of 11. So they were expecting 6 multiplier, but they got 11 multiplier. And the reason that that was possible was because of the operations in the physical plane. Good companies aren't necessarily good investments. We see executive compensation, like I mentioned at the beginning of the video, heavily linked to share price performance over relatively short time periods. So it's often easier for executives to earn more by turning around a weak performing company than by taking a high performing company to the next level. I am guilty of this as well. Anyway, the fourth and final cornerstone of value is that the value of a business depends on who is managing it and what strategy they pursue, i.e., the best owner. In many videos on this channel, I mention the importance of leadership and how that's not being an inspiring leader to your followers, but that means making strategic decisions in cooperating with other businesses and undergoing said cooperation with integrity. So you put your ass on the line for that cooperation. That holds way more value than any other accounting magic trick, because we see this in geopolitics as well. So different owners will generate different cash flows for a given business based on their unique abilities to add value and their unique friendships and everything. Related to this is the idea that there is no such number as an inherent value for a business. Rather, a business has a given value only relative to who owns and operates it. The 4 cornerstones of finance provide a stable frame of reference for making sound managerial decisions that lead to lasting value creation. I insist on lasting. Ignoring them leads to poor decisions that erode the value of companies and in some cases create widespread stock market bubbles and painful financial crises. I don't want this video to be doomy and gloomy related to the current state of the stock market and how Mark Rowan from Apollo said that we basically bet the entire retirement fund of the United States against Nvidia stock. But it is what it is. As such, I highly believe in our right as individuals to think of an idea that solves a problem, build a business around it, grow the business, and sell parts of it or the entire thing if we please. At the same time, I believe in our freedom to acquire stake in another business or even another business entirely in order for us to have our safety diversified, because I know for a fact I'm not going to have a pension, like a retirement plan from the country that I am from. And I also know that my savings invested in the things that I'm invested in, they also have no guarantee. So if you are a business owner, I recommend holding stake in more than just one business and just be diversified. Now to the end, I want to talk a little bit about me and how I got here in the first place. I have a PhD in architecture. My research was about the behavior of buildings over time. I researched during COVID when nobody was using office space and everybody was locked up at home, and these homes weren't really prepared for that. So it was interesting to see how we think as architects that we know everything about how people should live their lives and build constructions in buildings. But no, you never know. And you have to pay attention not only to the individual's needs, but to the general tendencies locally and globally. And I've always loved this about architecture because it is the crystallized conclusion of all of these big factors, like of common sense, of economical environments, of political environments. And this has always been going on ever since we started having city states like Babylon and stuff. Anyway, one of the parts of my research was to determine how we decide if a building, let's say a really old building like a former factory, that cannot be used as a factory anymore because it's too small or too close to the city center. Those use many times those go through something called adaptive reuse, which means that they change the usage of that building, and it goes through physical changes as well, like heavy physical changes as well, because of I don't know, firefighting, compliancy, because of monumental legislation and things like that. So this is way more expensive. Taking a really old existing building, and making it serve a different purpose is way more expensive than just building a new building. And I was fascinated. It's like way more because you never know what's underneath, and that structure you can't really trust it for your new equipment, like new types of elevators. Many times there weren't even any elevators invented at the time of these buildings when they were built. It's like digging for dinosaurs, you know? So I was fascinated on how we decide what buildings to keep and what to demolish. How do we decide the true value of old buildings? And what I have learned in my research is that there is no standard way to determine the true value of a building, because value is more given to buildings. I'm referring here. Value is given more by meaning and not by some measurable physical science things. And it's just the same. I go back to the beginning with numbers and narratives, how numbers are only 50% of the value of something and the narrative is another 50%. I think it's absolutely fascinating how humans create meaning around something, and that meaning translates into monetary value as well. So to wrap this incoherent video up, I would like you to pay attention to your business, to pay attention to the distinct two planes of existence of your business, and see how you can create value for your business, for yourself, or for somebody else who would like to be a little more diversified. And now you can watch another video about how to make the biggest comeback in your business. Thank you for watching this unscripted video.